Hello, everybody, and welcome to another MetalCon Live. Today's presentation is called Understanding Business Valuation and Mergers and Acquisitions, and it is being presented by Karl Wohler, Senior Consultant for PSMJ Resources. Before we get too far into things today, I wanted to make sure that you mark your calendars for July 12th when MCA, or the Metal Construction Association, presents Buying MCM, what the industry has in store for you. MetalCon is coming up in just a few months, you guys, and registration is officially open. Be sure to register now to guarantee the best rate possible if you plan on attending. We are so pleased to announce that Karl, who is our host of today's webinar, will also be doing an 8-hour workshop at MetalCon this year. The workshop is called Mergers and Acquisitions, an Essential Workshop. As a special bonus, if you decide to attend this workshop, you'll get a complimentary one-on-one with Karl in person in October. Lastly, this course is approved for AIA LU credits. Please fill in the form at the end of the session to ensure that you receive your certificate of attendance. If you have any questions during the seminar, please feel free to reach out in the chat box or in the Q&A section, and myself or a member of our team will see that. And if it is appropriate, we will share that with Karl. Without further ado, I'm going to hand this over to Karl. Karl, take it away.
Thank you. Good afternoon.
And Karl, you can go ahead and start sharing your screen again. It may have just turned it off because I was sharing.
Okay, great. Here we go. Hello, my name is Karl Wohler. I'm with PSMJ Resources. I have been working in the M&A arena for about 25 years and joined PSMJ in 2016, specializing in the M&A sell-side advisory practice in the worlds of interest to PSMJ, which is architecture, engineering, construction services, and also the MetalCon world of construction materials.
Karl, I'm just going to let you know that we're not currently seeing your slides. You don't mind just...
Sure, I'm sorry about that. Hold on.
That's okay, thank you.
How's that?
Perfect. We're seeing that right now.
Great. So what I'm going to do today is try to give you an overview of mergers and acquisition process. Lots to cover in 1 hour, so we'll try to do a high-level review of key topics. One key area is how does the M&A process work, and what are typical deal structures in the sale of a business in an M&A transaction. We're also going to spend some time on valuation review. Valuation is often misunderstood as far as the way it works in the market for a market rate sale of a company to another party. Lots of valuation methods out there and practices, but there's one specific practice that is by far and away the most common when it comes to transacting businesses, and we're going to go over that. A lot of private equity activity in all markets recently, and it is growing every day. There is a huge amount of capital in that market looking for acquisitions. It is a very interesting and attractive option for owners of companies, possibly interested in transitioning. It's one of many options to think about, and we'll talk about that across the spectrum of options. With that, we'll talk about also the full field of options available to sellers. If you're thinking of transacting your business, we like to say that there is a wide spectrum of options available to you with many shades of gray, and different options may have different appeals and drawbacks. And depending on your situation and your ownership structure and the goals that the owners have and the goals you have for the firm and the brand, there may be some options that are better for you or more attractive to you than others. So we want to talk about those choices. And then lastly, I'll finish up with things to try to avoid in ownership transition. So, a little bit background on myself. I'm a chemical engineer by training, 20 years at Polaroid, switched to M&A at Polaroid. New assignment by the CEO, one of the assignments I was recruited for, got me into M&A about 25 years ago, and I've been doing it ever since. I've worked in M&A across many different industries, big companies and small. I've worked for DuPont, Chargeurs, Philips Electronics, and Kodak. I was also the VP of M&A of a billion-dollar printing company in New York City. Joined PSMJ in 2016, so I've been in this specific industry for 7 years. And one of the things I can tell you over the course of my 25 years in working in the M&A trade, it's a pretty standard process across all industries. And what you're going to hear from me today is really pretty generic and common within the market of M&A, and certainly applies to this group. Let me start by talking about M&A process and deal structure. First thing I want to do is we probably have interested buyers on this call as well as interested sellers. So I want to talk a little about kind of on the buy side. Even if you're a seller, it's always good to understand what are the motives and what drives buyer interest to have an interest in your firm. So from a standpoint of, why, if you own a company, get involved with M&A, one of the key reasons is it's a vehicle to support your growth objectives. And if you have been a small firm and have relied on organic growth only, acquisition can become another arrow in your quiver, if you will, on the growth planning. If you've done cold starts before to geographically expand, we see some experience where cold starts are a bit of a crapshoot. Sometimes they work great. Sometimes it can be a long time to get a remote office in another city up and running. So the concept of an acquisition is pretty basic, and that is that if you buy a stable firm that has cash flow profit, you do no harm and you preserve that profit, the profit should be able to, over a reasonable period of time, pay for the acquisition. Very similar to buying a 3-family apartment building. If you buy it with good tenants that keep the place up, they don't leave and they pay the rent, you can pretty much over some period of time pay for the property with rent. So that's the concept of cash flow, can be used in the future to fund the acquisition. And if you do it right, in addition to just buying a stream of cash flow, if you find something that fits really well with your company, you may find additional synergy where you can find additional profit through acquisition synergy, the classic 1 + 1 = 3. A good example of that would be if you have clients that have activities in other cities you can't serve from your location. If you acquire a firm in that area, you get their employees and their clients, their revenue and their profit, but perhaps you can use that location to sell additional services and product to your existing relationship. So you're leveraging your relationship in this new location to get 3 out of 1 + 1. You could also do it with service area expansion. If you add a new service that you did not have in the past, you can add that service and possibly sell it to your clients, and vice versa, sell your services to the clients of the acquired firm. So that's the goal. But there is a risk with acquisitions. Culture fit and integration. If you buy a firm and the key employees and key clients leave, you will destroy value. In the architecture and engineering part of this business, it is a human capital business. So your key assets are fugitive. They can leave. So that can be a challenge. But that's typically what drives buyers. They're looking for synergy. So we typically don't see If you are, for example, an engineering firm doing MEP in Pittsburgh, it's not likely that a firm that does MEP in Pittsburgh is going to want to buy you because they already know how to do MEP and they already know Pittsburgh. It might be a firm that is near you, but not in your market, that wants to enter your geography or is in an adjoining discipline. So it's typically not overlap interest, but what I would call, synergistic or near proximity activity that drives buyers. I will tell you, for the buyers out there, if you're going out into the market, make sure that you have a clear strategy. Don't go out and just shop and look for whatever is available. Acquisition strategy should fall under your overall corporate growth strategy. You should have a growth strategy that has clearly defined goals. And where do you want to be in 5 years? How is that different from where you are today? How are you going to use acquisition as a tool to fill that gap and bridge the gap to your new reality? So you should, when you go to the market, you should have kind of a profile of, it's like going to the store with a shopping list. You want to have a profile of generally what you're looking for: size, geography, service. It's the idea of being a disciplined buyer. But the real world of acquisition is, once you make your target list, unfortunately, you can't wave a magic wand and have a firm that matches it exactly arrive on your doorstep in 2 months. So you do need to blend strategy with available opportunity, and that's where some judgment comes in. But I do, encourage buyers or people interested in buyers, make sure you have a plan and a criteria, and make sure that you're always, checking it against your overall strategy. So let's talk about deal structure and terms. One of the things about selling a company is companies are not sold for all cash at closing. Like selling a house, you go to a closing, the mortgage gets paid off, you get a net proceeds check, and you walk away free and clear. Not how companies sell. Almost all companies sell with some combination of cash at close and other deferred compensation. If you're in a professional services organization or you're a key leader, almost all transactions come with some stay obligation or commitment from key leaders, because one of the things that all buyers look for is they want stability and continuity. They don't want to upset the apple cart. They don't want anything to deteriorate at the closing. So with that, key leaders will be typically, the industry standard in the industry is a stay period of probably 3 years. That's a typical ask or desire from the buyer side. With that being said, we close plenty of deals where key shareholders transition out in 1 or 2 years. I will tell you, if you're thinking about selling or, in the near term, short term, or even a few years or 5 years out, part of your planning to sell should be leadership transition and client relationship management transition. That will help you with your to get a better and faster transition time if you want. But anyway, one of the things to keep in mind is, when it comes to valuation, you can get a valuation for a firm, but deal structure means a lot, and there is a huge impact. You could possibly get an $8 million offer and a $10 million offer. The $8 million offer could be more attractive because of the deal structure elements of it. So it's a big factor in overall net value. The first area that's very important in deal structure is what type of deal is proposed by the buyer. Buyers, there's generally 2 types of purchases. In one case, the buyer purchases the assets of the company and selected liabilities. In this case, you are not selling the legal entity. The buyer is essentially extracting the assets and selected liabilities out of that legal entity And on the closing date, we'll literally extract them out and drop them into a new legal entity. The important legal concept is that buyers typically prefer asset purchases for two reasons. Number one is they get a step up in basis on all the assets in this transition. So it's better from a depreciation and tax deductibility going forward. The second reason is if you've been in business for 30 years, by buying the assets, the buyer is isolating themselves from the liabilities known and unknown prior to the closing. So there is a nice liability separation, if you will, and it's a cleaner deal. The problem with an asset purchase, on the other hand, it's a little more difficult to manage because you literally need to move all your employees into the new legal entity, change payroll over a year, transition the benefits into the new legal entity. And your client contracts need to be transferred with the client consents moving over. So a little bit more challenging from a execution standpoint. But I will tell you, very common with buyers for the tax and liability reasons. And I will tell you that it's a common approach for smaller firms, and I'll get into that. Because quite frankly, as the firm gets smaller, it's more of a buyer's market, and the buyers can basically dictate the terms. Stock purchase, in the other case, is you're actually selling the legal entities. So if there are 4 shareholders that own shares in an S corp, they literally go to a closing table virtually and sell the paper that says I own this, and the legal entity changes ownership. It's an easier transition. It is better for the seller because the seller gets better tax treatment in the taxation on the capital gains, on the gains from the sale. It's easier logistically because all the bank accounts stay in place, contracts stay in place, and the liability of the company and the history shifts to the buyer. Buyers will do stock purchases. They will have a longer and more detailed reps, warranties, and indemnifications section that they'll look for the sellers to, make some pledges and provide warranties around liabilities prior to the closing. So those are the two basic structures, very different in the tax consequences to both sides. There is a kind of a twist in that there is an IRS provision called a 338H10 election, which is part of the IRS code, that allows both sides to agree to do a stock deal from a legal standpoint, but for tax purposes treated as an asset sale. Long and short of it is there's a lot of legal and tax consequences. Part of your process in selling a firm and buying a firm is you need expert M&A tax advisory support to advise on the tax consequences of the deal structure. Next part of deal structure is terms. We typically see 50 to 70 or 80% cash at close, almost virtually never 100% cash at close. Sometimes we'll see as high as 90%, but in any event, the remainder will be made up in different types of deferred payments. The deferred payments could be a seller note where you actually give a loan to the buyer and they pay you over a few years with interest. It could be in the form of rolled equity. You may have shareholders in the firm that are mixed in terms of age, position in life, timetable to retirement. You may have younger shareholders that want to roll equity and continue to be an owner. There will be options out there to pick a partner that will allow rolled equity, so some members can redeem their shares for cash and others can roll their equity and remain an owner, or do some combination of both. So rolled equity is an important part of any shareholders group discussion around, what are the goals of each individual shareholder and what type of buyer structure do we want. Another form of deferred payment is what's referred to as an earnout. This is a payment made after the closing, typically a year or a year and 2 years after, What's different with an earnout is it's not only paid later, but it's also contingent on hitting performance metrics after the fact. So for example, you could sell a company for $10 million where 8 million was cash at close, but 2 million was an earnout payable $1 million after 12 months and $1 million after 24 months based on hitting revenue and profit numbers for those 2 years. Needless to say, from a seller's standpoint, getting 10 million cash at closing is much better than getting 8 at closing and have 2 at risk. But sometimes an earnout can be a good way to bridge a gap between valuation expectations or address some other challenge around the firm that makes valuation difficult. We, for example, through COVID, had a number of firms on the market and they took a profit hit. We had these profit hits could have been 20 or 40%. We had interested buyers, but they were worried about, overpaying. So we had some deals closed where the price at closing was adjusted downward to reflect the dip in profits with an earnout available on the recovery. And pretty much every client that we had that sold with those hit it out of the park with a great recovery and got paid in full on their earnouts coming out. But again, it's something to think about. Another part of deal structure that's important to recognize is the standard structure in the industry is cash-free, debt-free. So if we were to say, for example, that your firm, you have an offer for 10 million to sell your firm, at the closing, you will get all the cash in your checking accounts, bank accounts for the firm. So that purchase price excludes all cash. It also excludes debt. So if you had a line of credit, if you had 2 million in your checking account and $1 million against the line of credit, your 10 million sale would be enhanced by the 2 million in cash at closing minus the $1 million in debt. So you get 11 million at the closing. One piece of the balance sheet that goes with the deal, and that is the working capital other than cash. So the buyer will get receivables and payables, and they will take your payables without any set off as a assumed debt, and they will get your receivables because it's considered part of the cash flow working capital of the firm. So that's the standard on deal structure. Talk a little bit about process. The industry typically has I would call it 3 phases as measured by document milestones. When you first meet buyer and seller, one of the things about the M&A process is it can be time consuming and expensive, especially when lawyers and CPAs and other advisors get involved. So the first thing is to share financials, get an NDA in place, and then, share financials, have conversations about goals alignment and interest. We typically recommend like a Teams video conference to do that. If buyers are really interested in our process, they'll say, we want to meet live with the seller group. And at that point, we would ask for a term sheet, or an indication of interest, which would be from the buyer, the first, communication in writing around deal structure, valuation range, key points, and the structure. The reason for this is the goal is, among other things, is make sure that you're aligned on valuation expectations. One of the things about the M&A market for companies is the range around which different buyers will pay for a company is much, much greater than you would see, for example, in the real estate market. So the simple goal of getting it's a 2 or 3 page bullet points, purchase price, deal structure, key factors. We need the CEO to stay for 18 months. We need this. We will do this with the brand. We're going to, anything that's important. We're going to maintain the location. Anything that's important, the seller should put on the table and ask for them to clarify in the offer. This offer will help you screen. If you have 2 or 3 offers, you can screen them for value and screen them for fit and other terms. And only after you see that would you invest the time to go to the next step, would be a live meeting where you meet for an afternoon and perhaps have dinner and social to get to know the people better. So that term sheet's the first important indication of interest. After a live meeting, and by the way, it's fine to be meeting with a couple of, or several different prospects if you're a seller. It's fine to decide to have live meetings with 2 or 3 or 4 or 5 interested prospects. So you want to find out, you want to get to meet the people, make sure there is a culture fit, values, goals, financial valuation fit. After the live meetings, interested buyers will come back with the next more detailed offer to purchase, referred to as a letter of intent. This will typically be a 10 or 20-page document prepared by the legal counsel of really the sellers. I'm sorry, the buyer side. By the way, you'll notice in all the offers and communications in the M&A process for business, the buyer is expected to come out first. That is how the market works in the sale of companies. Sale of real estate, seller sets an ask price and puts it up on the market. In the sale of a business, the seller provides revenue and adjusted EBITDA with the expectation the buyer will come out with the first valuation indication in the term sheet, followed up by the letter of intent. So the letter of intent will be more detailed. We encourage buyers and sellers at this point to get everything that's important to them on the table, discussed, agreed, and documented, because we really want this letter of intent to be, in essence, the deal. You may get an LOI from 2 or 3. You can negotiate at any point, but the important point, and we advise our clients when we're advising sellers, this letter of intent signature is probably the most important decision point in the entire process, because among other things, the letter of intent will include a paragraph from the buyer saying, we want, and you will commit to an exclusivity period for us to move forward, go through due diligence, create documents, and negotiate them and close this deal. It's typically 2 to 3 months, could be 4 months from the LOI to the closing date, because of the time it takes to go through due diligence and document prep. The buyer wants to protect their investment. It's easy, and it's not unusual for a buyer to spend $50,000 or $100,000 or $200,000, depending on the size of the deal, in legal and accounting, due diligence support, plus a ton of their time. They want to protect that investment with a promise from the seller saying that, we have agreed on a deal here. It's subject to due diligence. We need to verify the price through due diligence, but we don't want to be 2 months into this and have you come back and say, geez, I just got an offer for 5% more. I'm walking to sell to someone else. As a seller, you can't do that. I mean, you really, our, recommendation and strong, advice to our selling clients is, you want to be 100% sure you want to close the deal as laid out in the letter of intent with the party you're at the table with, and move forward in good faith to close the deal. Once that is signed, there will be a whole bunch of purchase agreement documents. It will be a set of documents. Closing is typically a simultaneous sign and close on one day, where all the documents are signed together. It would include shareholder agreements if you're rolling equity, employment agreements for any stay periods, lease agreements if you own the real estate through a separate LLC, and any other documents like that. Any questions, by the way, so far? I'm happy to take questions as we go through.
No questions yet,
Okay.
Karl. I'll keep you in mind if I see anything through.
Yeah, no problem. I'm going to try to go through this quickly. There's a lot of content here. And I think Kayla mentioned you can get in touch with her to get a copy of the slide deck as well.
Absolutely.
All right, so we're going to talk about valuation. I got to tell you that valuation for businesses can be a real challenge. It's not well understood by a lot of people, and there can be a lot of misconceptions. So because of that, we highly encourage both sides to get valuation on the table early in the process. You could be miles and miles apart, and it's really good to avoid wasting time to do that. The other important thing is that culture, philosophy, and goals alignment is very important. So in the M&A process, when talking to another party, you should be very polite and clear as to what your goals are. And if there is a goal mismatch, don't be afraid to say, you know what, this is not a fit, and walk away friends early. Better for a fast no than a long protracted maybe that becomes a no. You really want to avoid late stage deal failure. It's painful and expensive in the M&A process. So, okay, confidentiality. We manage it in the M&A process by going out with a teaser, which is a one-page summary, to a selected list of targets that we propose, but the seller client certainly reviews and approves, and obviously has veto on anybody they don't think is a good fit or they're concerned about from a confidentiality standpoint. We go out with a sanitized teaser to this list, which generically describes the firm, does not give your identity or location, but it might say an Eastern US, construction fab company that builds a certain type of metal system. But we would be working carefully with the client to be generic enough so not to give away your identity. This way we can go to buyers to find out, and it's called a teaser because it's to tease out interest. When we tease out interest, if someone sees it as an area of interest, they'll sign an NDA that includes, among other things, keeping the information confidential, as you'll share financials. But also there will be a provision that they have to keep the sale process and the discussions confidential. And that's how we protect and go into the market carefully, and can engage discussion with interested buyers without getting it on the street to your employees, clients, and competitors that you're thinking about or in the middle of a sale process. Very important part of the process. Okay. Moving on to valuation, lots here. I'm going to go through it quickly. The important thing is we're in a market here. And what I'm going to explain to you how the market works is not a PSMJ method or Karl's method or anyone's method. It's how the market works. And you will see all kinds of different methods, but this is the one that the market has set as the standard. And it's how the market works to transact. Because if you want to transact, you need both sides working with the same sheet of music with the same set of metrics. And this is how it works. And by the way, since we're in the market, it's fair market value that drives it. And that's what a willing buyer will pay a willing seller. And it's set by the market, just like comps in real estate. So you'll see all kinds of different methods out there. One you'll see a lot is you take a forecast and do a net present value. It is not used in M&A because it's subjective and it's on future projections. Asset values are only used in M&A for low value companies with low profit. Typically an asset value is low. It's essentially your liquidation value. Close the doors, collect your receivables, sell all your assets, pay all your bills. What am I left with? That's your asset value. So if you're a going concern and you have profit, it's the market cash flow value that gives you more value. And it is this market cash flow value based on a market index that's used in over 90% of all M&A transactions in all industries. I mentioned earlier, I've worked in several industries. This is used in all industries worldwide. So, the big rule for valuation of companies is it's all about cash flow, and the cash flow metric that the industry uses is EBITDA, earnings before interest, taxes, and depreciation and amortization. So here's the formula. You are a firm that creates profit. It is recast from your net income to adjusted EBITDA, which is a financial recasting of your net income, and you multiply that times a market multiple, and that's the market indexing that gives you your market value. So why is it accrual-based EBITDA? Because it's the best metric and proxy for cash flow. As you know, your full P&L has non-cash items in it, such as depreciation and amortization. If you have taxes in it, we want pre-tax cash flow. If you have interest, that's on a bank loan, that's going to be paid off at closing. So we want a loan-free, debt-free look at your cash flow. It's the equivalent for those of you in the real estate world. It's the equivalent of net operating income when owning, say, a commercial property such as an apartment building. So now we also adjust or recast EBITDA. This is, again, an M&A standard convention, which, by the way, if you're a seller or an owner and someone knocks on your door and asks for your financials, if you send them your financials unadjusted, you're likely to get a lower value because they're going to be running off your operating profit without the proper adjustments, which are typically going to increase your adjusted EBITDA. But this adjustment process is a recasting to get you to a better indication of what the historical run rate of your firm has been. There are some nuances around privately held companies and how they account for things that need to be recast. For example, if you're an owner and a CEO, you can pay yourself any salary you want, from triple market to zero to right at market. When you pay yourself way above market, you're basically taking profit out of the business through your compensation. If you're a C Corp, that's a very good way to do it, to avoid the double tax layers in a C corporation. So the first thing that you need to do is normalize your P&L for the last 3 years to show normal market level compensation and bonus. If you own the real estate, you want to normalize that to a market rate, because your decision on what you're going to charge yourself for rent, that's really a decision between you and your tax advisor on where and how you want to pay your taxes. So, that should be normalized. And by the way, if you do own the real estate and you say you're renting it for half market right now, because that's, the way you would want to recast your last 3 years to full market. And at the closing, you're going to sign a full market rate lease for the property. Very few buyers would be interested in the property, but once you sell the firm, if you're interested in selling the real estate, you certainly want a market rate lease with a good buyer in place to get full value for the real estate. Companies that are closely held may also have some owner's expenses on the P&L that, some tax advisors, suggest run your life through your business. And there may be personal vacation trips or, spouse's cell phone or some other things like that. All those things can be added back to recast the financials without any owner's influences in the P&L. Now, as you can imagine, at the closing, even if you were to stay for 3 years, those expenses would need to move to you personally. But that's only fair. You expect that, with the other owner, they want to see a market normalized P&L, and that's what they'll value on. If you've had any non-recurring items in the last couple of years, the market will allow you to add those back. Sold a firm in Las Vegas where the owner had spent $30,000 the year before on office carpet. Since you do that every 5, 6, 8 years, maybe, we put in that add back and added it to his EBITDA because it wasn't reflective of their run rate. And the buyers looked at it and they said that was okay. And just that. Bonuses are kind of tricky when it comes to this. If you have non-shareholders that get bonuses, even if they're discretionary, you need to leave them in because they're part of your operating cost, that you have base salary and you have bonus. The only bonuses that can be added back are shareholder bonuses that are used to take profit out of the business. What should be left is a normalized bonus level for people in the leadership levels. So again, it's this adjusted EBITDA that the market uses the metric for valuation. So we would use a template like this, where the top section up here is your operating profit right from your P&L. Again, right from your P&L, we'd add back interest, taxes, depreciation to get to this unadjusted EBITDA. But then the M&A advisors will work with you on all the recasting adjustments to take you through to adjusted EBITDA. To get this string of adjusted EBITDA on the bottom, that will be the basis for valuation that the buyers will use. The market use then, it's a standard, okay? Now, with this, the question becomes, what's the right multiple now that I have my metric, which is adjusted EBITDA? And unfortunately, unlike the real estate market where transactions are in the public domain, there aren't, many published sale prices, especially with, smaller firms in the 2 to 25, 50 million revenue range. So there can be, there's a bit of a vacuum of information out there. And it can result in some people having expectations that are using the wrong metrics. And it's one of the reasons why we suggest, get your valuation expectations out earlier. The other thing that's really helpful is if you understand this, it's very easy to have a high-level conversation around alignment on valuation by talking about price multiple. And just that. So with that, price multiples, one other complication is price multiples have a median, but there's also a spread around the median. The other complication is that price multiples increase as the size of the company increase, as measured by your cash flow or adjusted EBITDA. So for anyone to say that a general, a construction contracting business in the space will trade at 4x, or an engineering firm will trade at 5x, it's really misleading to say. You really can't say that because size matters. It really matters. It is harder to sell smaller firms, and the valuations are lower on a price multiple basis. So, here's, kind of a look at how price multiples increase as the size and profitability of the firm increase with adjusted EBITDA. So with that, it's important that if you are a 1 million EBITDA firm, you do not use the price multiple metric that you heard for a 10 million EBITDA firm, because that is a different market and a different metric. And it will not apply to your firm. You need to understand that these move and are dependent on size. So, here is kind of a table of kind of where we see the medians, and this is recently in the market. And as you can see, a $10 million firm trades on a multiple basis at twice the multiple of a $1 million firm. So on a price per pound basis, if you think about EBITDA as the pounds of flesh you're selling, $10 million firm will sell at twice the multiple on that. So one of the things for sure, if you're a business owner thinking about how do I improve the value of my firm, it's increase your adjusted EBITDA over time. And by the way, it kind of pays double, because if you double your EBITDA, you're going to double the left side of your equation. But if you double your EBITDA, you could also increase the multiple, say from 3x to 4x, or 4x to 6x. So it really pays significantly. Certainly one message there. And I will tell you that as you get larger, you will have more options. There will be more interested buyers. As companies get $1 million of EBITDA or lower, there are some buyers that stay away from them because they're perceived as being more risky, with the stability risk being that they have too much founder dependence. And if your goal is retirement, that may be more of a challenge on stability. So because of this, this is what a overall valuation profile looks like for a firm. Remember, I said that as your EBITDA goes to zero, on the EBITDA equation, you would go to zero value. So if you're low value, this flat line over here is essentially your asset or liquidation value. But at some point, your cash flow multiple value exceeds it. And this extra value is sometimes referred to as goodwill or intangible or going concern value. But you'll also notice that since the price multiple increased, this curve doesn't go up linearly. It goes up, with a little bit of a geometric progression. So that's what firm value looks like versus adjusted EBITDA. And again, this is pretty much across all industries. Now, the multiples will be different across different industries. Construction, at risk, general contractors with bonding requirements trade at lower multiples than these. A software company, 80% gross margins, high intellectual property protection, huge profit margins would sell at higher margins. But if you own an engineering firm or a metal products company, don't look at the price multiple on a software company and bring it over to your industry, because they do vary by industry and type of company. One other thing to keep in mind with valuation is, as we've talked about medians, there is quite a bit of a spread around what different buyers will pay for the same firm. So if this case were a $1 million EBITDA firm that might have a median at 4x, you will see a spread from down to low as 3 or 2x up to perhaps 9x on what different buyers will pay for the same firm. This is one reason why, among others, one of the industry standards is buyers never set an ask price. You might say, well, how does sellers never should set an ask price. You might say, how can a buyer gauge, is this the right size for us? Can I afford it? When you are provided adjusted EBITDA and it's $1 million, you should know that if the median's around 4, you can guess that the market middle might be around 4x or 4 million. But again, setting any price could leave money on the table for us, a buyer that will pay a premium. And you might ask, why might some buyers pay 8x when the median is 4x? If the company is public, they may have a cost of capital, or the public market pays them 20x for their shares. They can pay a premium against the market, and it's still accretive to earnings. So their overall, financial reward for buying EBITDA is higher in the public market, and they're willing to share that with a company they like. Other buyers may see synergy and see an absolute synergy that they're sure about. And if their synergy is something they have high confidence in, they will include some of that synergy premium in a reward with a higher price. So something to think about in the sale process. Different buyers for the same firm might pay different amounts, and that's again going to public companies can pay more. One other thing that comes up in valuation is, do you use a single year or a 3-year average? Some strategic buyers like to use 3-year averages. Most private equity buyers use trailing 12. And of course, you want to be thinking about it. A 3-year average makes sense if you have cyclical earnings, because that's the best indication of what your run rate is over a longer period of time. If, on the other hand, you're like the green firm here and you're growing, it would be unfair and you'd actually be punished for your growth. We would look for sellers to pay on a trailing 12 on that green trajectory. But it is something to think about on both sides and understand, is the buyer and seller looking for a multi-year average or a single year point? So, if you're an owner and you're thinking about maximizing value, and this could be because you want to sell next year or 3 years or 10 years, it's something you should think about over the life cycle of your firm. If you're interested in increasing value, is run your business, to improve your adjusted EBITDA. First of all, if you're not familiar with adjusted EBITDA and you don't track it, you should start tracking it at the end of the year, every year, even if you're not selling, because it's your best scorecard as to if you're increasing the value of your firm. I would say it's the equivalent of going to college for 4 years and not looking at your GPA. EBITDA is like GPA around the one number around value creation in your firm. Another important factor is to have fantastic, really good financial reporting. You should run your books on accrual financials. A lot of small firms are cash basis. For tax, it makes perfect sense, but you should run your business on accrual financials and have good accrual financial reporting, because that is the correct metric for evaluating the value of the firm. Adjusted EBITDA on accrual financials. Buyers will not use cash basis because of all the things that can happen. The things that the IRS code allows you to do, which is, at the end of the year to, defer taxes. Well, they want proper period matching and proper period reporting to get a good, strong sense on that. Avoid customer concentration. If you have a top client over 30%, we say 20% here, you should be working overtime to reduce that. That is a risk that will result in lower sale price. You should be developing leadership. You should be distributing client relationships, because that will help buyers get comfortable that when the key leaders move on, that the place isn't going to fall apart. Also say to be careful when you're building your firm, be careful about how much you diversify. Buyers typically like pure plays. If you diversify into things that aren't related, you might find some buyers that don't want the part that you're diversifying into, and you might have some less appeal. So be careful about any diversification strategy around. If you have any exit plans in the future, it may result in less buyer interest. So internal, I'm not going to go through that a lot in the interest of time here, but it's in the slide deck for you to review. Typically trades 20 to 80% below. It's typically based on the fact that it's what discount will the owners be willing to give the friends and family, if you will, the inside, and what can the cash flow of the firm support in an internal transition. Our advice on internal transition, and by the way, we do have advisors at PSMJ that specialize in developing and implementing internal transition plans. That's not me, but we have others we can introduce you to. They can help you implement that plan. So again, key takeaways. It's all about adjusted EBITDA and the stability and the perceived growth of it growing forward. Cyclicality of earnings, key client, key customer, key person reliance are valuation killers. Try to avoid them. Private equity, coming into the space in a very significant way in all industries. They have a ton of cash to invest. In our space, they are very much focused on partnering with leadership. They look for rolled equity because they want alignment of interest and skin in the game. They certainly have enough to pay 100% cash if they wanted to. They don't want to parachute in and run your firm. They want leadership continuity. They want to partner and create a win-win. If you've heard of some bad stories of private equities that are slash burn, flip artists, close factories, move manufacturing offshore, doesn't exist in this industry. It's all about, and it's not about cutting office and back CFOs and HR managers and redundancy. It's all about growth and synergy. We've had a lot of success. We've closed a lot of deals with private equity in the last couple of years. And generally speaking, our clients have been really pleased with the outcome. But it's not for everyone. It's one of the options. But one of the things we do like to say is, there are some differences between private equity and strategic, and there's no right or wrong for anyone, but these options are available to you. There are some pros and cons. I'm running short on time here. And again, this is the spectrum that I referred to earlier. There's no right or wrong solution. One of the things I would advise for any seller or seller shareholder group, understand what the goals are of each individual shareholders and the collective goals of the group for themselves and the firm. And with that, you ought to be developing a profile of an ideal transaction partner, and an ideal transition and future for the firm. And then once you have that, you can look across the spectrum to find the best fit. So I think I'm going to end it with that. There's some $1 million mistakes to avoid. I think I've pretty much hit on those already. So with that, I'm going to turn it back to Kayla and see if there's any questions. She wants to wrap it up.
We did not have any questions, Karl. So I think that means that you've covered all the bases pretty well. I will let everyone know that if you are interested, Karl is doing complimentary 30-minute virtual consultations. So please make sure that you check that link that's featured in the chat box so you can register for one of those. The other thing I wanted to reiterate is that Karl will be doing an 8-hour in-person in-depth workshop about mergers and acquisitions this October. on Tuesday, October 17th at the Las Vegas Convention Center. So there's a registration link in the chat box as well for that. With the registration to that workshop, you also get a 1 hour in-person complimentary meeting with Karl as well. If you have any questions regarding this session, please feel free to reach out to me. My name is Kaylin and my email address is kaylin@metalcon.com. We will be sending out the slides to anyone who has requested them. So again, if you would like to request those slides, please email kaylin@metalcon.com and I'll be happy to get those over to you. And for anyone who's watching us live, we do have this webinar being recorded and it will be on the MetalCon YouTube channel within 24 hours after it has been completed. So by 2 p.m. on Tuesday, June 22nd, this will be live on YouTube. So I want to say a huge thank you to Karl for taking the time out of his day and speaking with us. If you have any questions about Karl or any questions about PSMJ and what they can do for you, you can reach out to Karl. His information is here on the screen, or you can reach out to PSMJ in general by checking out their website, psmj.com, and they'll be happy to connect with you. Thank you, everyone who is still watching with us today. We appreciate you being here. And again, for your continuing education credits, just make sure that you fill in the little form at the end of this webinar, and we'll make sure that you get that credit and that you'll get your certificate. If you have any further questions, you can always reach out to MetalCon. We'll be happy to help you out in any way that we can. Thank you, everyone, for watching today. Special thank you to Karl and a special thank you to the M&A team for being here with us. Have a great rest of your day, everybody, and we'll see you on July 12th for the next MetalCon Live. Goodbye, everyone.
Take care.